Hey guys and gals, Kevin Bupp here. I've got some very exciting news I'd like to share with you before we jump into today's show. Now, after closing on Fund 4's first acquisition of a $50 million institutional grade mobile home park, we're adding a second irreplaceable piece of real estate to the portfolio, and it's coming into the fund with over $1.5 million of built-in equity for our investors day one. Now, when I say irreplaceable, I really do mean it. I mean, this is an affordable yet high-end waterfront mobile home park located in the Columbus, Ohio market. Quite literally, every single mobile home on this property is right on the lake, each with its very own personal boat dock, meaning a very high demand for affordable weekend getaway options, as well as year-round housing for working Americans. This is a true unicorn of a property, and you will not see another one like this come around again. It really is a one of a kind. A few other aspects worth noting. This park is producing stable and predictable cash flow day one. We're acquiring it with an excellent in-place Freddie Mac loan at a 3.3% interest rate for the next 8.5 years. This also includes a period of interest-only payments. Again, the simple supply and demand dynamics here are enough to get excited about. This is affordable lakefront real estate for both the working American families as well as folks looking to lock down a reasonably priced waterfront escape. Don't let this opportunity pass you by. Visit investwithsunrise.com to register for our webinar and learn about all the wonderful aspects of this property going into Fund 4. Again, that's investwithsunrise.com. Now, let's get on to the show. Hey guys, Kevin Bupp here, and I want to welcome you to another episode of the Real Estate Investing for Cash Flow podcast. Our mission is to help you build and maintain massive amounts of cash flow through income-producing real estate investments. Now, our guest for this week's show is tax strategist and real estate investment expert, Thomas Castelli. Now, Thomas specializes in helping real estate investors keep more of their hard-earned dollars in their pockets and out of the government's. Over his tax career, he has worked on one-on-one with hundreds of real estate investors to help them reduce their tax bills. And on the investing side, he's an active multifamily sponsor. He has also invested in multiple syndications and funds as a limited partner. So he's got experience with both sides of the table here. Now, in addition to his real estate and tax endeavors, Thomas also hosts the Tax Smart REI podcast, which averages over 100,000 listeners per month and has nearly 4 million downloads. And so, guys, without further ado, I'd like to welcome Thomas Castelli to the show. My friend, how you doing today?
Very well. Thanks for having me on, Kevin. It's an honor to be here today.
Yeah, excited to have you here. I know that we actually just talked shop on your podcast yesterday, so excited to have you here today with us. And hopefully we'll have a lot of fun talking everything and anything related to tax, but more specifically, tax savings, right? I think
Right.
that's what is always top of mind for us real estate investors. And so before we dive into all the fun conversations here, maybe just I'll give you that brief introduction, maybe, take a few moments and fill in the blanks a little bit about your background, kind of your story, and ultimately how you found your way into not just real estate per se, but into the tax world.
Yeah, absolutely. So it all started, when I was in high school. My parents and the influences, teachers and stuff told me to go to college, right? So I always wanted to go to college for business. And when I got into college, they said, if you're going to do business, you have to do either accounting or finance. Otherwise, you're wasting your time. That's what they told me. So I said, okay, you know what? I'll go ahead and do accounting. So that's how I kind of got into accounting in the first place, was through college. And then while I was in, I think, my sophomore year, I picked up a few personal finance books, one of them being Rich Dad, Poor Dad, which I'm sure everybody's familiar with. And that kind of sent me down the real estate path. I kind of realized that a lot of wealthy people really did have real estate in their portfolios. So what ended up happening was my great uncle had passed away. He had a relatively large property with a small house on it. I knew there was opportunity there. I knew it could be like 2-3 houses could be put up on it. So I went to a Long Island real estate RIA event. So the Real Estate Investment Association. And I found out about this 3-day weekend on real estate syndication. So I said, you know what, let me go ahead, let me go to this 3-day weekend, and fell in love with the syndication business model. Started going to their monthly meetings, started investing as a limited partner, got to take a look behind the curtain, if you will. And then they came to me and said, hey, Tom, by the way, if you ever find a deal, we'll syndicate it with you. So I eventually hit the phones, found a deal, and we syndicated it. 82 unit apartments in Jacksonville. We since went full cycle. But then around that same time, I was an auditor at BDO, national accounting firm. And I was like, at the end of the day, audit, this corporate stuff just isn't really my style. How can I pair my accounting background with my passion for real estate? And that's when I met Brennan Hall, the founder of Hall CPA. And I came on board as a tax strategist, and it was able to help a lot of real estate investors reduce their taxes. So that's kind of how I got. That's kind of how I got into the game. First started with college, reading a book,
Yeah.
going to a seminar, and next thing you know, it turned into a career. So.
Just curious, your parents sent you on that path. Are they both accountants themselves, or just curious how that came about?
Yeah, no. So my dad's actually in tech. My mom's a bookkeeper. She worked for a lot of
Okay.
accountants in her life, and I think she saw what they were doing, and she's like, "You need to become an accountant." On top of that, my aunt's a CPA, so that was probably an influence on it as well. So
Sure, sure. And also curious about whatever happened with your grandfather's property. So you originally went to, and I'm not trying to go down some different deep rabbit holes here, but
yeah,
you mentioned you brought that up part of the story about going to that RIA group, and it was first and foremost to learn what the possibilities or opportunity might be with this
yeah.
this tract of land. And so what ultimately came of that? Anything?
Yeah, so the executor of the estate basically was overwhelmed by everybody trying to jump in on something. So when I called him up, I was like, "Hey, we all know there's something there. I like to, help, do something with it rather than just see it sold." Long story short, he didn't want to have anything to do with that, so he
Hmm.
just sold the property. But I will say that whoever bought the property, I don't know who did. They knocked down the house and put up three houses, developed three houses, and by the way, this is prime real estate. Like if you walk 2 minutes down the block, it's the Long Island Railroad that goes directly into Penn Station in Manhattan. So this
Mm,
is like perfect for like a city commuter, like where I'm based. So that really grinded my gears, but at least let me know that I knew what I was looking at. You know what I
yeah,
mean? So
absolutely, absolutely. Well, no, good. Yeah, you should have been the bidder on it, right? You should have put up
yeah,
your bid and bought the opportunity. But anyway, needless to say, so let's talk about. I'd like to maybe approach this from an angle of clients coming to you, clients that own real estate. Maybe they're in different stages of their real estate investing journey, from owning one rental unit to having a number of syndicates underneath their belt as a GP or as an LP. We can take it from any perspective, but what are some of the most common tax, I guess, mistakes, or maybe it's common tax benefits that investors miss out on
right.
when they don't have the right tax guidance or tax counsel representing them.
Okay.
What are, like, your clients come in, they've had an accountant for 15 years that's been doing
Yeah.
their taxes for them, and you take a look at both whatever taxes you're filing for the current year, or for, I guess, for the year prior, and you look at some years
Yeah.
past, you're like, oh my gosh, you've been missing out on X, Y, and Z. I think I can help you out, not just with your current, the current taxes, but like, I can maybe give some guidance moving forward about how we can, approach things in the future. So just curious to know from your perspective what those common things are.
Yeah, absolutely. So I'm gonna start with some of the basics, then I'll kind of get into some of the more advanced stuff because we kind of see it from from the basics to the advanced
Yeah.
stuff missing out. So the first thing is just common expenses that people just don't have. Like they'll forget to report their insurance, they'll forget to report their property tax, their some of their repairs. It's just that's kind of one of the biggest things. People just aren't reporting everything. It's either due to poor bookkeeping or their accountants who they're working with just don't know what they're doing, right? So that's kind of the more basic stuff, just missing out on simple deductions. Now, when
Hmm.
we kind of get into the more advanced stuff, we're looking at something called the real estate professional status, right? So the real estate professional status allows, so by default, real estate under the tax code is passive, and what that means is that losses from rental real estate can typically only offset other passive income, typically more rental real estate. And the problem with that is you don't want to tie up these losses. You don't want these to be suspended in like and not usable. You want to be able to use these. So the real estate professional status allows you to take these losses and use them to offset your active income, say your W-2 or your active business income, if you meet certain requirements like spending 750 hours and more than half your total working time in real estate. So this is a super powerful tax election, and there's a lot of investors who are full time in real estate that just don't even know this exists, don't even know they're eligible for it.
Hmm.
And we see investors all the time who qualify and miss out. And we're talking about 5 to 6 figures in tax savings and in some cases.
You
And
actually see a lot of like full-time active investors, not guys that have a W-2 and then they also, kind of moonlight as a real estate investor. But you truly see a lot of full-time investors that haven't provided that guidance of what that designation is?
Yeah, so
That's
we see,
shocking.
yeah, we see it a lot, and it's because we see it from both sides too. We see a lot of people erroneously using it too, like in the W-2
That's right.
situation. But
Yeah, we could talk about that. I'd be curious to get your perspective on it because I feel like that probably happens more often than not.
yeah,
But anyway, we don't have to go down that rabbit hole now.
yeah, but we do see it because a lot of times people will be working with like a generalist CPA who like knows enough about a lot, but not really goes deep into real estate. Like to give an example, I'm not going to name any names or any specific numbers for obvious reasons, but one of our clients basically never did a cost segregation study before.
Mm,
And now this is another one that's often missed is a cost segregation study, which allows you, long story short, to rapidly accelerate and increase your depreciation expense. We never
mhm,
seen them do that before. They never did one their entire like their entire career, investment career, and we were able to go back and amend some of their returns, get some of that back for them, and the savings was almost in seven figures when all was said and done. And the amount we were able to save them in taxes because they had such a massive portfolio. So that's another instance, missing cost segregation studies. That's just another one. Like, and we have generalist CPAs tell clients all the time, you can't use a cost segregation study,
mm.
which is
Why
just
is
not
that?
true.
Why do they? I mean, I think most of the time, the guidance that's provided by maybe another tax professional, like it's not meant to misguide
Yeah.
their clients. It's just obviously they're not in the know. But what are some of the reasons that they say like I do not suggest it or you cannot do a
Yeah.
cost segregation study? I mean, what's some of the the reasons behind that?
Yeah, so there's a few reasons. So the first one I would say is what I'm starting to coin as the term like compliance officer syndrome. And that's when the CPA starts to see that their client's saving too much money. Like, oh my God,
Mm,
you can't do that. And they just get nervous and scared and they just tell their clients, no, you can't do that. Right. Just because like they might be saving too much money. That's the first reason. The second reason is they're not aware of the real estate professional status in some cases. So they'll just say, oh no, if you use a cost segregation study, all your losses will be suspended and carried forward, even though this person does qualify for the real estate professional status. Like just because they can't make that connection,
mhm.
that's another reason. In other cases, it's because they can't qualify for the real estate professional status and they say, okay, well, you can't use a cost segregation study. And that's not true. If you have a
Interesting.
property, say you're passive, it's like I'm a passive investor in the sense of the tax code, I'm not a real estate professional. If I go buy a property, I can run a cost segregation study on it, use it to generate losses through accelerating that depreciation expense.
Mhm.
If I have another property that's being sold in the same year, now that those losses can offset the gain on the sale of the other property.
Yeah.
So it's just they don't a lot of times they just don't understand how all these things connect.
Interesting. Just from your personal experience, I'm sure there's a few cost seg experts that you guys have worked with, time and time
Yeah.
again. They know their craft quite well, but have you guys run across maybe, some cost seg companies that like get a little too aggressive or maybe push the envelope quite a bit that would cause reason for concern?
Yeah, I mean, we certainly see some. I don't want to name any names that probably
No,
get.
I wouldn't expect you to do that. Just curious. I mean, you guys are seeing it through different lenses than I. Like we use the same group for the last, whatever, 5, 6 years, and they're phenomenal. They're top rated. And again, I'm not going to give any shameless plugs or anything like that. But I'm assuming that there's not, there's some not necessarily bad actors, but just again, push it to the gray a little bit, further than what they should.
Yeah, no, without doubt. There's definitely, because we have a lot of clients who go and get estimates from multiple cost segregation companies, and then kind of shop around based on price or how much they think they can get. And there's this one situation where um, a really well-known group did the cost segregation study for a client, or not a client, it wasn't a client of ours. It was an investor we were considering onboarding. But they basically what ended up happening was they went and they did the cost segregation study with a very reputable company. That cost segregation cut study came in low, right? It came in low, quote unquote. Then they went to another company and it came in very high. They went to the company came in very high. They ended up getting audited, and
Mm.
the IRS basically said you have to basically this is the way it should actually look, and it was much closer to the other reputable company. So you just have to watch out. Some companies will get aggressive with the rules, and that could be problematic for you under audit.
And I'm assuming, we kind of glossed over the word audit and what that really means. I mean, it becomes very intrusive, right?
Yeah,
And just time consuming process. I'm assuming, correct? I've
yeah.
never been audited, but I'm assuming it's an absolute nightmare, and it's pulling your resources from, away from where they should really be focused, which is probably growing your business and focusing on your
Right.
investments, right?
Yeah,
So definitely not a road that you want to go down if you can avoid it.
exactly.
Interesting. Okay. And I also want to make sure we don't gloss over the real estate professional. So just, for those that aren't aware, and to provide clarity, it's 750 hours a year, correct? To kind of
Yeah.
meet the, that particular stat. So you got to be actively working as a real estate investor in your business 750 hours or more a year to
Yeah.
qualify.
Yeah,
Got it.
so it's 750 hours and more than half your total working time.
Hmm.
So that's the qualifications, and it's in to meet that 750 hours. That's in what they call real property trades or businesses, and there's about 11 of them. It includes brokerage, development, redevelopment, construction, property management, leasing is named in there. There's rental properties. There's a few other ones that are just obscure, but basically, it's if you're in one of these businesses, like or fixing and flipping, wholesaling, if you're doing that full time, you can meet that 750-hour and more than half your total working time requirement. That will qualify you as a real estate professional.
Have you seen or heard of any cases where someone has abused that designation and, truly doesn't qualify, based on
Oh,
those parameters, to where it's actually come back to legally bite them?
Oh yeah, absolutely. So this is one of the most litigated areas of the tax code. There's over 500 tax court cases on the real estate professional status. And what you'll find in many of these cases, the reason why the taxpayers lose is a few reasons. The first one is they don't have any documentation of that they qualify. So usually the best way to prove that you qualify is by having a time log or some calendar system that demonstrates the amount you time you spent so you qualify. So that's the first reason. The second reason is people actually don't qualify, and this happens a lot with W-2 jobs. So if you have a W-2 job, the IRS considers you to be working 2,080 hours per year.
Mhm.
So that's about 40 hours per week. Now, if you were to now, in order to spend more than half of your total working time in a real property trader business, you would need to spend 2,081 hours or more in that business, meaning that you're basically working 81 or more hours per week every week for the entire year. And the IRS doesn't buy that. The tax courts don't buy that. And there's like literally dozens of tax court cases where people are trying to skate by the rules, and it just does not fly.
Yeah.
So that's if you have a full-time W-2 job, the chances of you actually being able to substantiate this status is highly unlikely, and that's just given the evidence that we have.
Yeah.
But I will throw one thing in there for everybody though, is that if you do have a full-time W-2 job, and if you're married, say your spouse can work full-time in
Mhm.
real estate, they can qualify, and now you both kind of qualify. So that's kind of an alternative route for that.
Yeah, and I think that's probably more commonly what you see, right? Like there's one W-2 in the household, the other one, doesn't have a W-2, and ultimately they actively work in the real estate business,
Right.
managing the rentals, managing the day to day, and ultimately, can qualify for that real estate professional status, correct?
Absolutely. Absolutely.
Okay. Well, fantastic. Let's talk about some new news.
Yeah.
What's new and exciting in the tax world. I mean, I know that one that I'm excited about. Maybe it's the only one. Maybe you know more, but is the chance. I think probably the good chance that bonus depreciation might be coming back in full force, and I think I don't follow it day by day, but I know that it passed in the House. I think it's just waiting
Yeah.
on Senate approval. But like the odds are that our odds are pretty good and pretty much in our favor that it will get passed. And I believe if it does get passed, it will extend 100% bonus depreciation through the end of 2026. Correct?
Yeah, so it would actually extend it through 2025. I thought when
2025.
I first
Okay.
read the bill, I don't know why they wrote it like that. Maybe there had to be some kind of compromise in there, but basically the way it would be written now is it would be retroactive to 2023. So you'd have 100% bonus depreciation in
Hmm.
2023, 2024, 2025, and then 2026 it would drop down to 20%, and then in 2027 it's gone under current law. So
Got
that's
it.
kind of what we're looking at now. And kind of like you mentioned, right now, it's waiting for the Senate to vote. There's a lot of tax professionals out there that believe that it might get stuffed into the appropriations bill in some way, shape, or form, which is coming up here. I think it's March 8th, if I'm not mistaken. But there's no word for sure yet.
Yeah, that's exciting. How about anything else? Any other news that we should be excited about?
Yeah, I mean, right now there's honestly not. That's probably the biggest thing right now for real estate investors in the tax world. There really hasn't been much else that's newsworthy. Everything has been kind of the same over probably the last few years since COVID, since that COVID bill passed. I forgot what it was called, but oh, the CARES Act.
Hmm.
Since then, there really hasn't been too much excitement, really.
Got it. How about asset classes? Maybe we'll talk about. I'm sure that your client base kind of runs the gamut of different asset classes that they're invested in, and maybe if you give some feedback on the various types of assets and the tax efficiencies that exist with each one respectively. Like I guess what are some of the most tax efficient asset classes to maybe the least tax efficient, if we would.
Yeah, yeah. From a tax perspective, probably the most tax efficient is probably gonna be car washes and
Hmm.
oil and gas state or gas
Hmm.
stations, excuse me, because there's a special carve out under the tax code that allows pretty much the entire thing to be written off using bonus depreciation,
Hmm.
which is uncommon in other asset classes. And I'd say probably next is going to be mobile home parks. And I know we discussed that on our show with you yesterday. But with mobile home parks, most of it's land improvements,
Hmm.
and land improvements are 15-year property, and that is eligible for bonus depreciation. So those assets can be extremely advantageous from a tax perspective. And then kind of from there, just in general, you're kind of getting into that multifamily commercial is probably going to be right under that. Um, and then you're going to be looking at the single family, and then under that you'll be looking at the condos and townhomes, things of that nature. But I will say that there's a few other asset classes not real estate related that are
How about
advantageous.
self storage? Where does that fall
Oh yeah, that's a
into
great
the
one.
equation?
Yeah, self-storage. That's a great question. I would say probably it's actually probably it would probably fall under below mobile home parks. Because
How are the metal buildings classified? I mean, I know sometimes self storage can be concrete block, they can be made out of metal, but more commonly, I think the new stuff it's mostly metal
yeah,
that's constructed of.
yeah, I'm gonna be upfront. I haven't taken a look at one of these studies in a while, the cost segregation studies on those. But it depends. I'm pretty sure it depends on to your point, the way it's built. If it's like detachable, sometimes like it's not affixed to the ground, you might be able to make a case that it's 5-year property and eligible for bonus
Hmm.
depreciation. Otherwise, if it's concrete block, for example, or if it's like just structurally bolted to the ground to the point where it's not where it's permanently stuck there, then you're looking probably at 39-year property. But from what I recall, self storage is has better. It's better than like a multifamily or commercial in general,
Hmm.
but not quite as powerful as like mobile home parks.
Got it. Got it. How about your personal investment activity? I mean, what excites you, given where we're at in the current real estate cycle? I mean, are you actively pursuing um, investments? If so, what asset classes do you typically look for?
Yeah, so I'm traditionally a multifamily investor. I
Hmm.
kind of came into that world through that 3-day weekend and through my LP investments when I first got started, and we eventually syndicated the deal. But in 2021, I kind of felt like we were at the top of the market. So what I did was I made an investment with a sponsor who's been in the game for a long time, and they took a more conservative approach to debt. And I was like, when I made that investment, I was a little concerned because I'm like, it's kind of lower returns, but maybe it's the right move. And long story short, it was the right move because a lot of people have these like the bridge debt
Yeah.
crisis that everybody's facing. People are doing capital calls, they're pausing distributions, and I didn't have to deal with any of that stuff. This deal is just chugging along. So I thought that was interesting. But being where we were with multifamily, I decided to make an investment into an industrial fund
Hmm.
because it was very well recommended, and I like the people, I like the deal, the underwriting, and everything. So I did that, and then recently I invested into an ATM fund that I'm using to finance a car. So
Got it.
that's probably my most exciting investment, only because like I'm like going to like I'm it's creative financing at play. Basically, the ATM machine drops money into my account every month, and then I take that money, I pay off the car payment, and it's exciting. So
Yeah. No, that's fantastic. No, it's yeah, I mean, speaking to the multifamily debt debacle that's kind of shaken out right now. It's interesting you mentioned that the investment you made was with they took a little bit more of a conservative debt approach, and I'd say we probably fall into that same camp as well. During the the craziness of 2020, 2021, 2022, before rates started really on their ramp up. We bought, but we didn't buy a lot. In fact, we probably sold more during those years, just taking advantage of the craziness and realizing some peak pricing, what we felt, and now that we know was the case. But with that being said, I will say that over the last year, I've slept quite well at nighttime, and we literally we've made our 24th consecutive, without pause, quarterly distribution to our investors. So like it's worked out. Yeah, I mean it's kind of it's when you it's I think it just goes back to the saying of like just try to go the opposite direction of the herd, right? And like that herd was running tight and running fast, for a number of years, thinking that things would never change, never shift. And so we just took a little bit more conservative approach, and I found ourselves now in just a fantastic position. In fact, it put us in such a good position that 2023 truly was our best growth year ever, and we were able to take advantage of some just incredible assets that came our way that other would have been competitors, their equity was dried up. Like they weren't competing on these deals. They didn't have the money, right? They were doing damage control on the rest of their portfolio, and
Yeah.
there we were in a perfect position to snap up some just incredible opportunities. So hopefully that continues to play out for this year as well. But it was just it's always good to just not follow the herd, go the opposite direction, and just trust your gut as well. And I think that's what a lot of folks ignored their gut,
Right.
and just if it looked good on paper, the rate's good today. We're just going to make the dangerous assumption that rates are not going to ever change in the future anytime soon. And we'll be able to get in and out of this in 3 years. Rates are going to continue climbing at, all-time record high on an annual basis. They're modeling out 7 and 8% annual increases, maybe even double digit, annual increases, which we did see, but surely that couldn't go on forever. In fact, now we're seeing a number of markets that have declining rents, which is funny because I went through '08. And the general consensus that I've heard over the last 10 years, since we've kind of been going through this ramp up phase, probably starting in like 2013, 14, is that rents never go down, and they've continued to climb for the last decade or so. But I can promise you, in 2008 and 2009, probably even 2010, in certain markets, rents definitely declined, and a lot of markets are actually seeing that impact now today. So it's just interesting times that we're in. But
Yeah.
I do think that guys like you and I, you're a little more conservative, are in a perfect position to take advantage of hopefully some good opportunities that start coming our way. Especially you being the multifamily space. I mean, just the amount of debt that's coming to maturity, and I know there's a lot of money on the sidelines waiting for those opportunistic deals, but it only takes a few. Like you don't need to find 100 great opportunities, and we know that there's a lot of debt that's at risk right now, that's going to be forcing owners to sell assets, and find one or two great opportunities at a maybe not a steal of a price, but a very fair price. I think you'll be winning. So
Yeah.
hopefully that comes your way.
Yeah, hopefully. I mean, I got something brewing. I've been actually on the passive side for the last few years, but I have something brewing like literally as like over the next few days that I might be jumping into on the active side. So I can't say anything about it right now, but I'm excited to jump back into the active side. I'll say that.
Yeah, no, absolutely. It's a good time to have access to capital, and be able to move when other people just truly can't move. They're not in position to actually make new acquisitions. So, with that, anything else, that you can think of, Thomas, that we should have touched on, could have touched on, that we didn't, that's worth mentioning before we wrap it up?
Yeah, I would just say this, like if you're out there, if you're playing the real estate game, you're now leveling up into another level of complexity when it comes to taxes, accounting, and finances and all of that. So you just want to make sure you surround yourself with advisors who can actually properly advise you, because you don't want to be one of those people who's missing out on 5 to 6 figures in tax savings because you didn't work with the right person. So I'm just saying, get out there and just surround yourself with people who know what they're doing, right? Your
Mhm.
general CPA probably is not going to be able to carry you as far as as you want to go if you're jumping into the real estate game. So that I'm not trying to sound self-serving there or anything like that, but I just see so many people like just screw up that it's just like, just make sure you're working with somebody who understands the real estate tax code. That's
I
all.
agree with you. Absolutely. And for those that want to learn more about you and make connect, reach out to you and connect with you, both from a professional level, but as well as even your podcast, go ahead and let folks know how they can reach you.
Yeah, the best place to reach me is actually thomascastelli.com/links. And the reason for that, just all my social media is right there. The link to the podcast is there if you want to request a consultation, to get a conversation started. All of that's right there at thomascastelli.com/links.
All righty. Well, fantastic. The guys will put that in the show notes. And Thomas, pleasure having you here. Glad that we could get you on our show, and excited to stay in contact with you. And best wishes to 2024 and those opportunities coming your way.
Likewise, Kevin, thank you so much for having me.
Alrighty, guys, that's all we have for today's show. So until we meet again next week, this is your host, Kevin Buff, wishing you huge success. Take care now.